Welcome to another season of Tank Talks with me, your host, Matt Cohen, founder and managing partner of Ripple Ventures. On this season, we are going to try something new and change things up a little bit with our new intro segment on the podcast, where before each weekly interview chat, we are going to invite a friend of the pod on the show to discuss the current news making headlines in the tech and venture capital ecosystem. Our goal is to give our audience a bit more insight on how we're thinking about the industry and the topics being discussed in the media at large. On today's news rundown, we welcome one of the most well-known venture capital investors and Canadian tech leaders to the show, the one and only John Ruffalo. Welcome to the show, John. It's great to have you back.
Thanks, Matt. It's a pleasure to be back.
John, as I introduced to the audience, we're going to change things up a bit this year, and we're going to do a bit of a news rundown segment before every weekly interview that we release on the podcast. And so I thought there'd be nobody better than one of the the great and oldest venture capital investors in the ecosystem here in Canada to have you on the show to discuss everything that's been going on. But I mean, I would first love to just get a sense of how you been, how you been over the last year. You've been sort of predicting a lot of the stuff that we've been seeing over the last year or so for a little bit of time. So do you feel a bit of vindication, or are you just sort of kind of getting a little bit used to what to do now?
Well, it's not vindication because it's only half of the battle. The other half was to wait for the implosion and now to make some good investments. But it's been a long time coming. And the only thing that I stress to folks is, and what drives me nuts when people are talking about the new normal, et cetera, there is no new normal. This is the old normal. The new normal was 2019 to 2021. We're going back to when things are actually making mathematical sense again.
Right. Yeah, it was the unnormal, I guess, is what you would say, from the time of 2019, 2020 up until the very end of it in end of 2021. But I guess what do you think about this sort of public-private debate? I mean, we had the flippening happen where the private markets were totally out of whack versus publics. Now the public markets are almost too out of whack compared to where the privates are right now. But what do you think about this debate? Which one should be leading the other, in your opinion?
Well, to me, it's always the public market from the perspective of you mark to mark on a daily basis in the public markets. And, maybe certain stocks might be old, but I would just say as a general rule of thumb, there is still more to go down on the public markets. Certainly not I don't think a huge amount, but I wouldn't be surprised if there's another 10 or 15% down. The problem with the private markets is that valuations are pretty much done at the whim of whenever an investor decides that they want to do it. And eventually, you get caught up to whether you've been overly aggressive on having too rosy of a picture. The private markets always lag the public markets. Based on my experience, it's typically 6 to 9 months. I'm going to suspect even right now, it's even taking longer than those 6 to 9 months for it to readjust.
Yeah. I mean, I think the only reconciliation we could see in the private markets is if we go through Q4 auditing season for those funds that are audited, like ours and yours are probably, that will see some sort of realignment.
A little bit.
Of where valuations, but you're right, just a little bit.
Just a little bit. I mean, I know how to play that game, and, the auditors don't know the business as well as the investors do. And so you paint as rosy as a picture as you want. And, the real question is, you could fool your LPs in the short term, but you won't fool them in the long term. And I've learned that it's way better to be honest with them over a long period of time, because they will back you time and time again. And there's going to be a lot of folks who are going to feel the wrath of their LPs in the near term.
Yeah, it's like short-term pain for long-term gain. I mean, or the opposite, actually. Short-term gain for long-term pain if you do it the wrong way. I mean, you obviously know everything about the auditing side. You started your career at Arthur Andersen, running the tech practice there. So with you running Mavericks right now, sitting with capital, I feel like the PE funds and sort of the growth equity funds that have capital like yours, you guys are ready to rock and roll.
Yes.
I mean, this is the time to shine. So what is it like and how opportunistic can you be in these situations?
Yeah. So for ourselves and other, private equity buyout funds as well, we are looking at this as a tremendous opportunity. However, when I speak to them right now, just like us, the bid-ask spread between what a seller wants to sell their companies at versus what a buyer wants to buy is still a materially wide delta. It's continuing to close. So, but a lot of folks are sitting on the sidelines waiting. I would say to you that for those private equity firms that do of public companies, they will go first by private companies doing significant financings.
Yeah, like we saw this with Tomo Bravo, obviously, yes. With Coupa, and we're going to see more of those in the public markets. But I think the only ones we're seeing in the private markets, and we've seen it firsthand with our sale of On-Call Health to Warburg Pincus back Qualifax, is that the bolt-on acquisitions to the already anchor assets in these PE funds are happening now. But the anchor assets that people want to build inside their private equity portfolio is like the platform asset. You're right; those bid-ask spreads are still pretty wide.
Right. And so if your balance sheet is not broken, the view that a lot of people are taking is, why do something now? Now, the answer is you don't have to necessarily do something now, but if there is an investor out there that could actually really help you grow through this down cycle, there is a lost opportunity cost. So that's the real question that a lot of the companies will need to make, certainly in 2023.
That's a great point. Actually, we spoke to one of our companies that was acquired by private equity at a good price for everyone, and the investors were happy. But they told us that they've already doubled revenue within a quarter just by unlocking what they can sell on top of the existing anchor platforms business, which is amazing. Just in terms of sort of the bid-ask spread, though, what really kind of doesn't make sense to me, and I'm sure you talk about this all the time, is the paid up capital in a lot of these later stage businesses is worth more than the valuation of what they probably are worth right now in an acquisition. Isn't it crazy?
It is. And, the two problems that I see is that you either have a founder problem or a pre-existing investor problem. And where you have the founder problem, they want to be called a unicorn and realizing that everyone's saying that the valuation's worth a fraction and they're looking for structured deals. Or B, a lot of pre-existing investors don't want to tell their LPs that their investment is worth a fraction of what they said it was worth only a few months ago. So are doing structured deals in order to buy time, hopefully do a fundraise, and then maybe, admit that maybe the portfolio either wasn't as strong or maybe it started to grow into its valuation 12 or 18 months later.
Yeah, absolutely. I mean, at Ripple, we decided that we're going to put a valuation framework ourselves, kind of like Freddie Wilson does, out there for our investors to actually look towards instead of having this like throwing darts at a board, because there's just no consistency. I don't think a lot of early stage funds are doing that, but we're going to try and do it.
One of the things that I did do when I went to Omer's 12 years ago, one of the first things that I had done, and I did this as a bit of an experiment as part of the valuation methodologies that I used. I looked at Omer's was originally an investor in a lot of different funds, and those funds co-invested in the same asset. And the spread or variances in valuations, the Canadian investors was so wide by, in the most egregious case, there was a 400% difference between one investor and another. And the magic thing is the one that had the massively high was out in the market trying to seek financing for.
Can you imagine if like hedge funds could do that in their public portfolios? Yeah, I don't think so.
Right.
It's almost like way worse than the bond markets, which were opaque to begin with. But we'll leave that for another discussion. Switching over to the sort of the operating and the business side, we've seen a ton of headlines with how Elon Musk has totally been able to right size a ship that has been sinking and bleeding money like crazy. And who knows, is still sinking, but not talking about whether or not Twitter will survive. But have you been inspired by the way in which he's been able to slash cost and server cost and build the company and almost 10x the product velocity with like 1/4 of the staff on hand? And do you think a lot of tech founders should take note of that and see what they can do with their own businesses?
Yeah, I mean, I would just alter that a little bit. Like in terms of his methodology in how he is approaching it, I would say I would have a very different view, but his end result of what he's trying to do, I am 100% supportive. It is quite amazing, the folks who are bashing him because of this freedom of speech and all this. And, I don't even want to get into this debate yet. The predictions that Twitter was going to be gone in 3 days was flooding my Twitter feeds, and what he's proving for sure, without any question, is how grossly fat Twitter was. I don't know what so many of those employees were doing in the first place. And I think so much of this stuff had gotten out of hand. And the one thing I could say is that when people say, oh my God, those halcyon years that Twitter was such a friendly, great place. Like, are you on the same Twitter that I've been on for the last 15 years? It's never a kumbaya place. It's always been they're toxic. And I don't remember the last innovation that this company has done. So I welcome it. Now, the jury will be out. Give him 6 months, give him 12 months to really see where he's going. And if he blows it up, then chastise him. But I love the fact that he's breaking things. And this is the thing that, Silicon Valley espouses. And yet he's attracted so much vitriol that I just think it's personal and it's quite ridiculous.
Yeah, I mean, I think a lot of our youngest founders in our, portfolio are looking at him as like the next Steve Jobs, and just in terms of like the relentless focus on product innovation and just cutting out a lot of the bullshit. And I think a lot of our young founders who are sort of living through this tough time as a first time, young founder, they're all looking around themselves and be like, who here is actually adding value? Who here is just a nice to have? And which ones of us can we kind of give their jobs to somebody else who will do it 10 times better? And we've had conversations with a lot of our founders who are like, I kind of want to cut the bottom 20% of my company every year, but my board won't let me from a culture standpoint.
Yeah.
And so it's tough. It's a very tough conversation to have with young founders who've never been through this, but they're taking inspiration from it.
I think so. You know what, the other thing that I would love to cut out, it always drove me nuts, is, certainly over the last 10 years, we've equated the growth of a company largely to the hiring of its employees. That's not scaling. How about holding your exact same number of employees and massively growing your revenues? Very, very hard to do. But that's what, in essence, Elon Musk is really doing. Can you do a whole lot more for less? And now, the downside, of course, is that a lot of these companies will become a lot skinnier. But there's been this massive fight for great talent. They'll find a spot in other companies and make them stronger as well.
Yeah, absolutely. I mean, we saw this at the slashing of jobs in the last crisis, in the global financial crisis, how many great tech companies got started because those people that were laid off were still interested in building and solving problems, got together at a coffee shop and started building, the next Uber or Airbnb and something. So you're going to see something happen from all of these layoffs and cuts in sort of workforces. But I think it's inspiring. I mean, we had one CEO call us and say, hey, what's the revenue per employee number we should be targeting? I'm like, you're a Series B company. I mean, I've never heard of companies at that. I mean, public companies are barely trying to achieve that goal, but it is a good mindset and a good muscle, I think, for them to try to achieve, even if it's not necessarily possible at this stage. Just quickly touching on some of the stuff we're seeing with like Mark Benioff and stuff, a company that's always been like kumbaya, they're slashing 10% of their jobs. We're seeing it across the industry. What do you think the ripple effect, no pun intended, is going to be across startups that are servicing a lot of these bigger tech companies, right? Everyone thinks like tech is kind of built on this, feeding pyramid where, everyone kind of feeds up to Google or Salesforce or something because they sell into them, right? Those are their large enterprise SaaS customers or vice versa. So do you think it's going to have like a big ripple effect across all these different sort of SaaS companies?
No, well, I mean, I think it's going to be a positive
of their user base.
I think it'll be a positive and a negative. If your business is predicated on selling to a whole bunch of other small startups, yes, you're going to have a real problem. Where with say a Salesforce or a Google that are in the inflationary pressures that a lot of the startups in Canada are facing. And there is no such thing as job creation for the tech sector because there is the demand far exceeds the supply. And so when you start having these cutbacks, they largely occur in the jurisdictions outside of the home country, which likely means that a number of the Canadian subsidiaries of these businesses will be shedding their employees. But these folks won't be going into the food stamp lineup. They'll be sought after all these other great Canadian startups. So I think that it actually gives an opportunity for the first time in at least 5 years for Canadian companies to hire some great talent and not lose out simply because a company could pay 2 or 3 times the amount of salary that some of these Canadian startups can't pay.
That's a great point. I mean, if Amazon or Facebook is not hiring 3,000 people in their Vancouver or Toronto offices, satellite offices, that frees up a lot of people to go and hire for your startups and for founders to create companies that I completely agree, hopefully at a much more reasonable cost, given the less competition for wages and stuff right now. Last thing I want to just touch on, because it's obviously the most consuming thing for everyone. I'm not sure if you've played around with it like everyone else, but ChatGPT, OpenAI, forgetting about like whether or not it's actually going to replace jobs, tomorrow. I got to ask you, have you been playing around with it?
I have been. I've unfortunately played it with my teen children, and their jaws dropped. Yeah. But aside from the obvious coolness factor, and even Sam Altman warned everybody calm down. This is just a very imperfect beta stage of the product. The interesting thing are all the possibilities. And if you speak to the folks at OpenAI or in Cohere in Toronto, where they really want to see this go is to help the developer community build code for various applications. And when you think about that potential, and I think about what GitHub did early on in capturing a lot of code that people developed. And now you could have a software that could actually pick the best codes and make it more elegant. Could it be that you don't necessarily need to be a software engineer to actually build code? And you could just simply use natural language processing to say what you wanted to do? That could be unpowerful. So we're just thinking about the possibility of applications of this is where it's very, very fun. But I still do think this is a number of years off. But the implications I do think are quite significant.
Yeah, I mean, I agree with you. We have obviously seen some of our own companies incorporated it into their products, Voiceful being, number one, building in a week the ability to consume, freestyle large language models into their application to design a chatbot on WhatsApp. Right. Do you have a real-time chat on anything you want? And everyone is consuming that. And I agree. I think over the weekend, showed my wife, who's a dentist and not really interested in a lot of the tech talk that I spew daily, when I got her to ask the chat GPT about some type of dental procedure or recommendation, her mind exploded when she saw how accurate it was and what she would actually probably say back to a patient. So she asked this morning if she was allowed to use it at work. I said, sure, why not? As long as you don't tell your bosses. But last thing, I mean, do you think it's going to have an impact on like content production, media, lawyers? I mean, I've heard it's been banned in New York State at the university level, I think.
Yeah, I think.
Do you think we're going to see laws change?
Yeah, I mean, this is very common, right? People see this thing here, they imagine the possibilities, they get very, very scared. I mean, the content creation, the cost of it is going to approach zero. It already was on that path. This is likely going to accelerate it. One of the areas, for example, that you do hear some concern, is it going to be a further threat to democracy from the perspective of the bad actors who are using social media to spew messages that, perhaps are a little untruthful or concocted. They could do this at massive warp speed. And so I think the combination of social media and the short form messaging could probably get worse before it gets better. And just like everything that, you and I experience in tech, it's always a double-edged sword. Everything that you think about it for the good, in the hands of the bad actors, you got to worry about how do you need to protect, particularly those folks who are most vulnerable. So I think we're going to see lots of good and equally lots of bad come out of this.
Yeah, absolutely. I mean, not to take it back to Elon, but he warned us about this. I mean, that's why they initially funded OpenAI as a not-for-profit, but realizing it cost them $3 million a day to fund it, they had to figure out a way to make some form of money. So we shall see this story unfold over the next little while. But thanks for joining us, John. I look forward to doing more of these in the future. And thanks for joining us for our first news rundown on Tank.
Great. Thanks, Ben. Appreciate it.
Now let's jump into the tank with Shahir Amin from Sonoma Brands to discuss how to spot the next CPG unicorn. Shahir shares his journey starting his career working at the University of North Carolina's endowment fund, supporting the private investment team, and how that impacted his views on the private markets and fund investments. We asked Shahir to explain how endowments view venture capital as an asset class and how emerging managers can start building relationships with endowments early on in their fund's journey. Next, we jump into how Sonoma Brands was started by legendary CPG leader John Sebastiani, who built one of the most well-known beef jerky brands, Crave Jerky, before exiting to Hershey in 2015. We uncover what Shahir looks for when backing the next CPG unicorn founder and how startups are able to compete with the Goliaths of CPG these days. Finally, we get Shahir to explain how venture funding in the CPG space has changed over the last few years with the rise of platform building with roll-up strategies in the brand space, and how his firm is standing out as a market leader for founders to partner with. Thanks for joining us in the tank today, Shahir.
Matt, stoked to be here, man. Appreciate you having me.
Shahir, it's so awesome to have you finally join us on the show today. We've been trying to schedule this for some time now after we spent a few days together golfing in Arizona earlier this year. I think we golfed in like 100-degree weather and probably drank a little bit too much and not enough water. But my background on you is a little foggy. So it would be great if you can give our listeners a bit of a background on yourself and how you got started working in technology and eventually the startup investing space.
Yeah, after spending a brief stint working in investment banking, like many of us unfortunately do, I've spent most of my career in investing in asset management. I started my career in the endowment investing world, where I worked for my alma mater, the University of North Carolina. I helped manage the private portfolio there, which was really any illiquid alternative asset class. So that included the private equity portfolio, which included anything from early stage venture to growth equity to traditional buyout strategies, in addition to real assets, which included real estate and energy and natural resources, and also private credit, which we refer to as enhanced fixed income back in the day. I left UNC Management Company in 2017 to join my current firm, Sonoma Brands Capital, a consumer-focused growth equity firm. So I made the jump from the LP world to the GP world. Here, I serve as one of 4 managing directors on the investment team, alongside my colleagues, John Sebastiani, our founder, of course, Brian Nicholson, Kevin Murphy. And I cover investments across the categories we invest in, and I'm personally involved in brand investments such as Guayaki, Milk Bar, Bauchons, and Manual.
So many amazing investments that we'll definitely get a double click on. But, you mentioned you started your career working at the University of North Carolina Endowment Fund on the private liquid side. And I believe the last time I checked, that endowment reached over $5.5 billion as an investment fund. What an incredible place to start your investing journey. Can you tell us about some of the incredible opportunities in terms of some of the, amazing GPs you got to sit down and meet with and learn from, as well as some of the challenges that came with that role early on in your career?
It was truly a marvelous experience. My PSA for the day is, if you're a college student, I highly encourage you to seek out opportunities with your respective university endowments and view it as a potential way to launch your career if you're interested in finance and investing. It was an incredibly fun job, and I think it often gets overlooked relative to banking, consulting, et cetera. You're managing a multi-billion-dollar pool of capital. In my case, it was roughly $5.5 billion at the time. I think it's closer to $8.5 billion today. And your primary objective is to both protect the corpus of the endowment, but to meaningfully and consistently compound it year after year, with the sole purpose of supporting the university, scholarships, professorships, new programs and buildings, research into perpetuity. When your investment horizon is theoretically infinite, I think it's both an asset, but can present its own unique challenges as well. It's great in the sense that it allows you to be more patient, flexible, take more risk, and ultimately be potentially more creative in your investing approach across asset classes, strategies within those asset classes. I think what's challenging, once you decide to allocate that capital, you're essentially a spectator as it relates to the investment decision, and it takes years to validate whether you made the right decision or not. I think a common misconception of endowment investing is, we're literally taking this pool of capital and investing it directly into Apple stocks or Apple stock or bonds or private companies. But in reality, you're selecting and allocating capital to managers, private equity managers, hedge fund managers, et cetera, to prosecute those strategies on your behalf. So you're a little removed from the action and from the ultimate asset. So sometimes it's when you're talking about things like target asset allocation, it takes years to really implement those strategies to be nimble. So you can decide one day that, yes, I want 30% allocation to private equity, but it's going to take you years to really be able to implement and deliver on those target asset allocations. It moves a little slower from that perspective.
Yeah, it's interesting to hear you say that. A lot of people think like endowments, all of a sudden a TechCrunch article comes out and says so-and-so wants to make more push into early stage venture or emerging managers. But like, one, it takes years to come up with that strategy. And two, it takes another, several years to deploy that strategy. And so people really should appreciate how slow things take, for good reason, on the endowment side. But who are some of the best investors you got to meet or work with that you still kind of carry relationships with until today?
I won't necessarily get into specific names, or ones I'm probably more comfortable sharing. We're in our venture portfolio, so getting the opportunity to partner with the Andreessens of the world, the founder funds of the world, the benchmarks of the world. When I really look at it across the various asset classes, venture, growth equity, buyout, most of the great investors understood what they were exceptional at and stayed true to that. They'd built repeatable processes around sourcing, diligence and execution, adding value. When they began deviating from their strategy or entering totally new strategies with ever increasing fund sizes, that's where you usually saw a dilution in returns.
That's a great point. I mean, from a selfish point of view, as an emerging manager myself, and for some of the other emerging manager listeners out there, how would you recommend them go about building relationships with endowments like UNC? And, how would you have evaluated them during your time there?
Totally. Yeah. I wish I could share some actual wisdom, but the truth is it's a very long fundraising cycle for endowments, and you need to get comfortable with hearing no for a while. Not all endowments view the world the same either. Some endowments are more comfortable with taking on risk and therefore more comfortable anchoring and backing first time or emerging managers. But many endowments won't even consider you until you're at least, at fund 3. So understanding that so you can be efficient with your time is key. I think most of all, LPs are great listeners and meticulous note takers. So they really care about, did you do what you said you were going to do when we first started building a relationship? Or did you start deviating from your strategy from the jump? They want clarity and commitment to a strategy. Yes, of course, it's okay to be opportunistic when it makes sense, and some LPs really like that. But in the early days, it's about consistency and story and following through on what you said you were going to do. I think LPs want their GPs to be great listeners too. Did you sincerely take some of their feedback to heart, whether it's fund size, capital deployment, et cetera? Demonstrate yourself to be a great partner. They don't care about what you behave like when everything is up and to the right. They care about who you are when you're grappling with real adversity and challenges. It's pretty simple at the end of the day. You're investing in people, and you want these people to be brilliant, of course, but most of all, high character and high integrity.
That is such great wisdom, even though it sounds very basic. It's like, find your rhythm, stay true to your promise, keep relationships going, and play the long game. And eventually you'll end up seeing through some of those commitments from some of those, long institutions like endowments like UNC, which is amazing. Thanks for sharing that. I mean, after 2 years at UNC, you moved over to your current position at Sonoma Brands Capital, first as a senior associate in 2017. So can you tell us a bit about the firm's origins and how you ended up working there in the first place?
Absolutely. It was quite serendipitous for me, but in talking about the firm's origins, it all starts with our founder, John Sebastiani. And, I look forward to the day when you can get to know him and hang out with him, because I think you'll find that he's one of the most sort of dynamic people that you'll meet in our space. But John came from a 4-generation Italian wine family based here in Sonoma. I think you could write maybe 5 seasons of an HBO show covering that, Italian, wine family business drama. But he sort of cut his teeth in the wine industry working for his family winery. Long story short, they sold the family winery in the mid 2000s, which John was the president of. And so, at that time, he was really faced with the tough decision of like how he was going to reinvent himself, because so much of his personal identity, so much of his experience was rooted in wine and rooted in this family business. I think John has always been a health and wellness and fitness enthusiast. After his family sold the winery, he's always been an avid runner and was really training for the New York City Marathon. You may know this, but a lot of runners who are training will eat jerky as a snack because it's high in protein. And so John was training for the New York City Marathon, eating jerky for its functional benefits. But when he looked at the actual products and the ingredient deck, it was terrible for you. At the time, the category was dominated by really 3 brands: Jack Link's, Alberto, and Slim Jim, and really viewed as sort of like a gas station gut stuffer, if you will. And so John was eating jerky because of its functional benefits, but realized and had this epiphany that, like, oh wow, there's actually not a health focused jerky product out there. So I'm going to come out with something that's all natural, that's gourmet, that's really going to elevate this category so that, you're not comparing yourself to a Slim Jim or Jack Link's. You're comparing yourself to Cliff Bar or a Chobani, and really elevating it with, John's born and bred here in Sonoma, which is, next step of one of the great sort of like culinary capitals, in our world. And so really sort of elevated the product to be very culinary forward as well, coming out with, ingredients and flavors like black cherry barbecue, chili lime, and really unique, interesting, attractive packaging. And because of some of those attributes and like dynamics, John was also able to usher in a totally new consumer. Yes, there were fitness focused, but he ushered in the female consumer, which was totally absent from the category at the time. And so all those things helped John really redefine the broader meat snacks category, which is, a multi-billion-dollar category. And he had a lot of success building Crave over the course of 5 years and ultimately sold his business to Hershey in 2015 for $250 million, and what was then and today still one of the highest multiples of revenue paid for a food business. And so after successfully selling his business to Hershey, he was really, again, faced with the question of like, what does he want to do next? And John really wanted to partner with the next generation of founders and entrepreneurs and help them build their business and achieve the success similar to what he was able to do at Crave with his sale to Hershey. And I think he also recognized that at that time, when he looked at the consumer-focused private equity firms out there, because John had to take capital in when he was building Crave as well, they all sort of look the same with similar backgrounds, a little more of a finance orientation, a little more of like a banking background, but he had a thesis that this next generation of founders and entrepreneurs, they want to work with someone who has been in their shoes, someone who was a highly successful former entrepreneur. And I think that's what, resonates with brands and entrepreneurs today. And, for myself, I was at UNC at the time, and it really sort of informed early on my approach and philosophy to investing, right? And at the time at UNC, we were really transitioning away from these large generalist managers to smaller sector-focused managers. Smaller managers just because of the greater alignment of interest between the LP and GP. You're not necessarily getting wealthy off of management teams backing small businesses because we thought it was a more efficient part of the capital markets, and then small teams because of the just more efficient decision making. But really what we honed in on was this sort of sector focused bias. Because we understood that there was a virtuous cycle created across the investment process when you focused on one particular sector or industry, a virtuous cycle across, sourcing, having to access and being able to win these deals, more efficient diligence and execution, and then of course, adding value post investment and the arguably the most important part of the investment process, knowing the particular buyers for these businesses. And so, at the time, we were really paying attention to what was happening in the broader consumer ecosystem, and just the uptick in innovation and a ton of enterprise being created. And we had legacy exposure to groups that had really kind of gotten larger and grown upstream, and so we were looking for that next consumer focused manager, and spent a significant amount of time really landscaping that landscape. And that's how I first actually got introduced to John. And me and my former team at UNC thought, Sonoma Brands was in its very early days, but we thought John was so dynamic, differentiating, and compelling. We wanted to stay close to him if he ever did decide to raise a true institutional fund. Thankfully, UNC was one of the first calls that he made when he made that decision. And I think for us at UNC, the thesis was pretty simple. It was a thesis that worked well for us in our venture capital asset class. But our thesis was that today's generation of founders and entrepreneurs want to work with someone who have been in their shoes, someone who has empathy for the challenges that they face in building their business, someone who has particular insights into their business model. And so given that entrepreneurial DNA, being able to talk the talk and walk the walk would give us not only access to the best entrepreneurs, founders, and deals, but an edge and an ability to win those deals, because we fundamentally believe that today's entrepreneur is looking, when evaluating a partner, looking much beyond capital and looking at the value that they can bring as an investor. So I'd gotten to know John, pretty intimately and closely over the over the course of that relationship building process. And so when he was looking to build out his investment team at the time, it was a sort of very natural fit in transition. And so I joined in 2017, really as the first hire on the investment team. So have firsthand been able to sort of watch us grow and evolve over the last 6 years, and invariably wore a lot of different hats in the earlier days. Of course, all things in investment process, but then also some operational aspects like fund admin, audit, tax. I've thankfully been able to shed some of those responsibilities over the last few years to just singularly focus on investing, but. It's been cool to be here from the ground floor.
I mean, that's a perfect example of what you shared earlier about how, building the relationship that John did, after having an incredible outcome himself personally, after reinventing himself after the wine industry with his family business, is a huge testament to how he picked up a new skill set along the way too, in building relationships with people at UNC like yourself. And then the biggest compliment ever could not be that you also invest and then you leave your job to go work for a GP that you obviously trusted with the endowment's capital. So incredible story and background. Thanks for sharing that. And, since starting in Sonoma, you guys have made some incredible investments like Milk Bar and Peckish, and one of my favorites, Beekeepers Naturals. I got to ask, first off, what do you guys look for in a CPG investment now? And what gets your team excited the most when you meet a CPG founder for the first time?
So I think one of the core tenets of our investment strategy and philosophy is we consider ourselves jockey investors. We want to back exceptional founders and entrepreneurs, and we understand a founder and their team are going to do 90+% of the work. We love founders who are thoughtful, steadfast, and resolute in their vision. I think, most successful founders don't create brands for the money. I mean, yes, that's certainly a part of it, but it's usually not the impetus or motivating force behind a founding story. It's typically rooted in some type of authenticity where they're trying to solve a personal problem or, really recognize this unmet demand that's really going to improve consumer lives. So like that authenticity to the brand and founding story is very key. And then of course attributes like brand affinity and loyalty, playing in large growing categories that might be a tad sleepy and starving for innovation. In order for us to really build conviction, the data has to be undeniable as well. Usually these brands are at some type of inflection point where they have limited distribution in a certain channel or a certain region, but you have enough data and traction to be able to extrapolate from there and really be able to predict performance as they continue to scale across channels, across retailers. So having that super compelling data story is critical. I think we love backing businesses and brands that can be true platform plays. They're not just selling a niche product or service. They do have the permissibility to enter into different categories, have the permissibility to show up in different parts of the grocery store. And then above all else, we're looking for brands that have a strong muscle in building communities through compelling content and experiences to build that intimacy with the consumer that ultimately leads to engagement and loyalty. More importantly, it just creates a flywheel across the entire brand building process.
I mean, kudos to you guys and the ability to see through so much noise in the industry. I know when I go into Whole Foods and look at that beverage section, my head explodes. I mean, there's so many options to choose from. There's probably 50 different types of kombucha sitting on the shelves. And so to be able to figure out which one's going to be the category leader is a skill that I don't think I'd ever have. But a couple other things I want to understand is like how important are brand attributes such as sustainability or supply chain transparency or these clean formations and healthy ingredients and stuff like that to your investment thesis?
Yeah, listen, I think they're important in the sense that you need to check the box on all those things to be relevant and really resonate with today's consumer and consumers and what they demand. But it's not necessarily important in like serving as like a true differentiation relative to other brands. More simply put, that these attributes are more table stakes. You need to have them to resonate, but it's not necessarily going to differentiate you from a sea of other brands on shelf. You have to, maintain, the priority of delivering an absolutely incredible experience with an incredible product as well.
Right. It's like a SaaS company only having one pricing. It's like you have to have three different tiers of pricing if you're going to be a SaaS company. It's table stakes, right? That makes total sense. Let's talk about the market in general, though. Despite the recent slowdown in years, and the CPG industry is still one of the largest sectors in North America, valued at over $2 trillion. And it's being led by established companies like Coca-Cola, Procter & Gamble, and L'Oreal. Can you give us a sense of what happened to these key players in the CPG industry in recent years, and how are they viewed in the market today?
Totally. I think, leading up to the pandemic, I think the data clearly shows and validates that, these large CPG strategics were ceding significant market share to these new entrants, emerging brands, because of that disconnect between, the products that they were offering and what today's consumer demanded from a health and wellness standpoint, a better for you standpoint, a supply chain transparency standpoint. And so that was, a well-established trend leading up to the pandemic. I think in the early months or, first couple of quarters of the pandemic, you saw that trend reverse a little bit, where both the retailers and consumers were sort of reverting back to the tried and true brands, like big food. But I think that was clearly shows that was just a very brief sort of moment that was specific to the pandemic. I think emerging out of the pandemic, you're continuing to see big CPG cede share to these new and emerging brands, and I think you'll continue to see that continue to see that going forward because of their inability to effectively and efficiently drive innovation. I think you'll continue to see them use M&A as an innovation pipeline, as a vehicle for innovation to continue to compete and resonate with today's consumers. I think when you look at Sonoma and the categories that we invest in, we invest across food and beverage, personal care and beauty, health and wellness, pet. And when you double click into each of those categories, you have, different, relevant strategics. In food, in beverage, you obviously have the big three: Coke, Pepsi, Keurig, Dr. Pepper. In food, you have, great companies like Hershey, Mondelez, Campbell's, General Mills, personal care and beauty. You name some of them: L'Oreal, Procter and Gamble. I think entrepreneurs and founders today still view strategics as a great home to ultimately sell their businesses into. Not all strategics are created the same and can operate very differently, but I think sort of a common theme that you see across all of them is that all of them have developed some type of like corporate venture arm to either serve as like an early stage M&A pipeline, or to just get them closer and more intimate with the market and what's happening, and really to extract and draw insights. Of course, some do it better than others, but yeah, I think you'll continue to see them, be active from an M&A front, and be great homes for a lot of the brands that we invest in.
Yeah, I mean, everyone knows that infographic you see where you've got the four main CPG leaders, Mars and Procter and Gamble and Johnson Johnson, and all the different entities that they've acquired over the years. It's quite incredible, PepsiCo and stuff. It's an amazing thing to see that web of small brands that we all associate as like independent, but really they've all been rolled up into these conglomerates over the years, and we'll continue to see that as well. How do investors like yourself normalize revenue growth for companies that saw, let's say, the massive spike we saw for a lot of CPG brands during the pandemic, which are probably tailing off in recent quarters?
Great question, and it's a bit of a tough one. We all thought the obvious pandemic beneficiaries were categories like outdoor furniture, exercise equipment, cooking accessories. What we didn't appreciate was how much health and wellness CPG products would experience a similar pull forward. We've seen that spike normalize in 2021 and into 2020, and it feels like we're back to pre-pandemic demand in that category, which is fine because the category was already experiencing solid growth prior to the pandemic as health and wellness is taking increasing mind share with consumers. The other group that experienced outside growth in that pandemic was big CPG, as we mentioned earlier, as consumers pantry loaded, and big CPG had the supply chain advantage to keep up with the demand spike. I think from us, from an underwriting standpoint, we've had multiple kind of quarters post pandemic, emerging out of the pandemic, and so we've seen enough sort of like quarters of like real data to really be able to triangulate what sort of true performance should have looked like during the pandemic. But I think, I think certainly from like strategics, certainly from, more growth investors like Sonoma, there was definitely a bit of skepticism. There's definitely a bit of discounting that was applied to performance during the pandemic, primarily for, direct to consumer oriented businesses that you really had to, like I said, discount and demonstrate a little bit of skepticism coming out of it.
I mean, there's obviously going to be a discount applied when a company gets started in, let's say, 2019 and has like a 20x growth in 2020. But some of that has not tailed off and continued on the momentum for a lot of these CPG companies. So there's always going to be outliers who may not deserve the discount. But I agree on general terms, it should be receiving an average or a discount if they have several years prior to the pandemic. For you to kind of base your investment thesis on. A lot of people are saying that e-commerce, as we know it, is dead, and that scaling a profitable DTC business on the back of Facebook advertising has basically become the exception now, not the rule. I mean, given everything we are seeing in the headwinds in regards to privacy and Google changing their cookies policy and Apple changing, their data policies, especially with their own ad direct products, what are your thoughts here in terms of the ability to build a really fast, scalable e-commerce D2C business in this current environment?
That's a great question. There's a lot in that question. I think the big trend we're seeing is brands realizing that new customer acquisition has become more difficult. They've neglected great opportunities to deliver more value to their best consumers. It's the 1,000 true fans concept. We're seeing a lot of interesting new technology companies popping up to help brands build their communities, membership and loyalty and subscription programs. That's what decentralized commerce and Web3 in particular can deliver for these consumer brands. The opportunity to facilitate and power incredibly special experiences like LTOs, product drops, and collaborations using protocols like NFTs. So there's a whole host of e-com enablement tools that necessarily didn't exist 5 or 6 years ago. So I absolutely.
Yeah, short answer is there is ways. You just got to be more creative and more thoughtful towards where the community of people are going towards. I love that idea of how brands now are creating their own commerce off their community, which is then giving them a feedback loop to build new products. It's like a focus group, that you can continue to test with all the time, which used to have to outsource that to like a consulting arm or something before, right?
No doubt. It's kind of what I was referencing earlier about just the flywheel created across brand building from more efficient, product development to A/B testing to go to market and commercialization. So it's an incredibly powerful tool and asset for brands today.
Totally. That makes sense. So I got to ask you, what are some of the trends we're seeing in CPG marketing that have changed since the pandemic?
The obvious one is we lost demos and experiential marketing during the pandemic. That was important in driving trial, in activations for young brands. It feels like that's starting to come back, but obviously CPG brands are more adept since the pandemic at driving trial online through paid social, Amazon, and new platforms like GoPuff and DoorDash. So the CPG marketers tool belt has gotten bigger. And just real quick on experiential marketing, it's always been a powerful brand building strategy, one that today's brands continue to deploy. But there's been an evolution largely driven by social and digital connectivity. So it's not enough to simply do in-store demos anymore, which is effective in driving trial, but it's more transactional in nature and doesn't necessarily create an emotional connection with the brand. What's essential now is to create branded experiences and create opportunities to communicate with consumers in a way that's genuine to the brand and in a way that connects them to your products and values.
Yeah, for sure. I mean, experiential marketing has just taken a new twist now since the pandemic. It's still like the heart of what a lot of CPG brands have to get right. It's just really changed in the way that it's being deployed, wouldn't you say?
Exactly.
So I got to ask, obviously CPG is now where I spend a lot of my time, if any, on the investment side, but there are a lot of investors who see a lot of opportunities to invest there, but no one is more than you probably. So how do you get venture level returns in the CPG space? Given that brands can scale much quicker, you can get a $10 million revenue CPG company that can get to $100 million in sales, sometimes a lot faster than, let's say, a traditional SaaS company. But it's rare to see that like $1 billion exit plus because of maybe the margins or the ways the businesses are being built. So therefore it makes your entry point really important. So how do you see exits and return on investments happening in your space, given that we've seen the rise and fall of SPACs and, IPOs are shut down for a bit of time right now? What is the viable path to exit and what kind of returns are you underwriting for in the CPG space?
For us, you're right. You don't see a ton of $1 billion exits in CPG. They're few and far between. You certainly see them in beverage, like brands like Body Armor. You've seen a handful of big kind of multi-billion-dollar food exits like Kind Bar or most recently Cliff Bar. But I think what's more common is seeing exits in the call it $300 to $500 million range. And I think to be able to underwrite to those type of outlier special returns, you really need a few things. Going back to what we were talking about earlier in our conversation, you really need a best-in-class, exceptional founder who's really going to make that vision come to life. Of course, supported by a team that we help build, but a lot of what we do starts and ends with the founder. You have to be playing in a large and growing category that's of strategic value and interest to a CPG buyer, right? Like really understanding what their go forward strategy is and the gaps in their current sort of product portfolio that they're going to want to fill through M&A over the coming years. And you really need a prioritization of fundamentals like margin and really prioritizing profitability earlier on in a company's life cycle and evolution as well. I think you're absolutely right about SPACs. I think it's very clear that it was a very ephemeral liquidity window and exit path for CPG brands. But the great thing about our space is historically there's been a lot of strategic interest in disruptive brands. When you look at the the landscape of CPG strategics. And, most strategics will, we've seen them continue to be active and we'll continue to see them be active. And then I think some of the learnings coming out of the pandemic has also encouraged and motivated brands and investors to, really deploy a more, disciplined approach to brand building relative to, some of the behavior you saw leading up to the pandemic, where, there really is a focus and premium applied to solving scalable gross margins earlier on and really profitability. And if you're able to build a brand in that way, if you're able to hit those discipline dimensions, then these brands will continue to be relevant, strategic assets for financial sponsors as well.
Right. Yeah. I mean, look, I think everyone understands that brand building is vital, but it gets to a point where good fiscal hygiene and good economic models still need to be true. And so if you're a CPG founder who's great at brand building and marketing and storytelling, you should have a right-hand person who understands the numbers and the return on ad spend and the COGS and all that in order for you to succeed, especially in this, capital environment. Wouldn't you say?
Totally. It's about marrying a great brand with a great business.
Right. Exactly. I mean, we're seeing the same thing, obviously, in software with capital efficiency being, important, if not more important, for a lot of, companies who were overly funded before. So how is Sonoma sticking out from the crowd of capital out there in the space in general? We saw a lot of roll-up strategies out there in the CPG space. We saw a lot of like Amazon roll-up players pop up over the last, year or two. How is Sonoma sticking out from the crowd without overfunding companies as well in order to build meaningful growth companies and get a good return on investment?
I think the most sort of salient feature about our strategy and the way that we like to add value to increase the probability of success of our brand partners is really, an omni-channel approach to brand building. And so I think a big part of our strategy is, oftentimes taking a traditional retail brand and helping them, grow their presence online, whether that's through their own .com, Amazon, et cetera. But then also, as importantly, not just transacting online, but building strong communities and engagement digitally as well. And then on the flip side, taking a digitally native brand and helping them expand into traditional, retail channels. We like to consider ourselves as omni-channel investors. It's a relevant strategy across, most, if not all of our portfolio companies. And I think when you look at the skill set of our broader team, a few of us are very adept and skilled and experienced in the traditional retail world. And a few of us are highly experienced and credible in the digital realm as well. And so kind of having that complementary approach to brand building, I think, certainly sets us apart. And then I think just kind of going back to the roots and legacy of Sonoma Brands as well, that entrepreneurial, founder-backed sort of heritage, stemming from John's background, really helps differentiate us, really across the sea of consumer-focused investors that are out there.
No, it's amazing. And the brands you have been backed and invested in, I always tell any CPG founder I get to have the chance to meet with, but I don't invest in because I don't ever make CPG investments. I always try to say, make sure you talk to, Shahir at Sonoma Brands and John. They're the real deal. I mean, I got to ask you, well, I got you, retail doesn't feel dead to me. Is it dead?
No, not at all. Not at all. I think, I think people love to talk in like extremes and absolutes, but I think when you observe the way consumers are actually behaving, continuing to behave, I think retail will always be a big part of meeting consumers where they're at. And again, really going back to that sort of bias towards omni-channel brand building.
Yeah, I agree. I mean, I think the Amazon purchase of Walmart will turn out to be a phenomenal investment for them, just because of the retail footprint it's given them. It's taken them time to get it right, but I think they will eventually. So I agree with you there. One last question before we jump into our final fast favorites. What used to be true for CPG but isn't anymore, in your opinion?
Yeah, I mean it's a little bit of a consistent theme with some of the topics we've addressed today. But I think 5 or 10 years ago, you could have sold your business to a strategic and with being 100% retail or 100% direct to consumer. But I think what's clear in just these active and intimate conversations with strategics is that's no longer the case. I think to really be a meaningful contributor to a larger strategic portfolio after M&A. They really need you to be viable and relevant across all channels. And there's more of there's more of a reservation. There's more hesitancy when a brand has not proven that ability. I think you're seeing that in real time in terms of how brands are actively sort of redeploying their channel approach. And I think that's a trend that's here to stay.
That is great advice. And given that you talk to so many of the corporate development folks at the large strategics, it's great for you to share that advice for a lot of our CPG founders out there looking to build maybe in one direction or the other. You got to do it all. And that's what they're looking for. Let's jump into our fast favorite section. So first off, your favorite podcast.
I love How I Built This. Just given my affinity for founders and entrepreneurs, there's so many amazing stories out there, and I can't get enough of it.
Yeah, I'm a huge fan. I have not paid for the subscription yet to the Guy Raz one, but I should probably. What's your favorite CPG one? I know mine was probably Stacy's Pita Chips. I love that story.
Oh, so I'm biased on that one. My favorite one was Christina Tosi, who's the founder of Milk Bar, and she's just electric and pure magic. So I can't hear her story enough.
Obviously, talking the investment, I get it. Next is your favorite newsletter or blog.
This one's pretty boring, but it's probably true in my life. Is Dan Permack's Axios. It's a fantastic way for me to get caught up every morning.
Have you been following him on Twitter recently? He's stirring the pot a lot. I like it.
I know, man. He's always a little bit of an instigator. So I love that about him.
Nice. Next is your favorite tech gadget.
One's current, one's more like aspirational. I think what we use the most at home is Amazon Alexa, incredible sort of voice recognition. I also want to, if you ask me this, in 3 or 4 months, I'll probably say an Oura Ring.
Oh, I got one on here. It's great. My wife hates it, but I love it. Favorite new trend?
That's a good one. I love how Formula One has really taken off with the U.S. Viewer and consumer, and obviously so much of that has been driven by the Netflix series Drive to Survive. I was not a big Formula One fan prior to the show, but it's really got me into it. I think amazing stories and sub stories, and so I find it extremely fascinating, and I love how the American viewer has really gotten behind it.
It is by far the most incredible rise to sort of fame. I mean, the way that John Malone has built this machine of like marketing and branding. I read the story about how they were the only program that Netflix had to pay that didn't own the rights to the content after they paid for it. They basically licensed the content. When they bought Formula One for like over, I think it was like $4 billion. They did all this marketing strategy, and it was like, how do we get to the US market? And Netflix was like the top of the list, which is pretty cool.
Amazing storytelling at the end of the day.
Absolutely. Favorite book?
Oh man, these are impossible questions. I would say one of the books that really sort of like added to my life is this book called the Blood Telegram. It really follows the story of Archer Blood, who worked for the U.S. Embassy in Bangladesh back in the late 60s, early 70s, and really tells the story of my family's from Bangladesh, and so it really tells the story of Bangladesh's liberation from West Pakistan, West Pakistan, which is now present day Pakistan, and just some of the weird, awkward alliances that were created as a result of the Cold War. And so given, that's the motherland, I never truly was able to appreciate and really respect everything that was involved in their liberation. And so it was a fascinating story for me.
That sounds interesting and obviously hits home for you as well. So thanks for sharing that. And last but not least, your favorite life lesson.
I think I'm going to go back to the family roots and, really just talk about my dad. And my dad and mother grew up in a super poor, remote village in Bangladesh, maybe 30 minutes outside of Chittagong, which is the second largest city there. And I think it was through incredible sort of grit, determination, motivation that, my dad was able to get himself out of the village, earn a scholarship to study at a U.S. college. And it took an incredible amount of sacrifice, essentially, removing yourself from your immediate family, moving halfway across the world at that age, and has really been here ever since with the primary objective of giving a better life to his children and his family. And but again, it came with an incredible amount of sacrifice. And so I think the lesson there is truly there are no shortcuts in life.
Yeah, amazing. I mean, and now, look at the offspring doing amazing things and finding the next CPG winner with Shahir Amin, partner at Sonoma Brands. Thanks so much for joining us, Shahir.
Matt, really appreciate you. Can't wait to do this again soon.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,